Hey, what's up, Path to Freedom listeners? And thank you for dropping into another episode. This is episode 116, and I'm joined today by Patrick Grimes. Patrick is the founder and CEO of Invest on Main Street, an alternative investment firm where they specialize in passive investments for multifamily real estate. They've got some investment opportunities in the oil and gas space as well, which Patrick does a really good job of kind of explaining, how they go about that. But, Patrick's background is, largely in real estate investing. He learned some hard lessons, back during the 08, 09 timeframe. And, since then, his mission has been to, create a platform where other successful people can put their money to work in a way that, they're going to have more control over it, but also get better returns than, the traditional options that you find via Wall Street, right? And, 401ks and IRAs. So, this is a topic that I'm personally very interested in, right? As you get to a certain point and you have money to invest, people are always looking for ways to put their money to work for them. And you guys know me, I talk a lot about business ownership and the benefits that can come with that. We own businesses and, that creates a lot of financial resources for us, fortunately, but you get to a point where you just don't have any more time, to dedicate to starting another business, right? And you guys have heard me say so many times that business ownership is never passive, right? Even when we talk franchising, and there's different types of franchise models out there in terms of the ownership profile, and there are some that are less time intensive for the franchise owner than others. That's how the model's designed. But at the end of the day, none of them are going to be truly passive, especially in the beginning. So, for business owners, having these smart passive income opportunities where you can put your money to work and grow your money, I think is very important. And, there's a lot of different ways that one can go about doing that outside of traditional investment opportunities. So that's what Patrick and his team are all about at Invest on Main Street. Patrick's got a book. He's got tons and tons of free resources on his website. So we're going to post links to all of that in the show notes to make it easy for you to find. So without further ado, let's drop in with Patrick Grimes of Invest on Main Street. All right. Hey, what's up, Path to Freedom listeners? And thank you so much for dropping into another episode. Today, I'm joined by Patrick Grimes. Patrick is the founder and CEO of Invest on Main Street. And I won't steal his thunder. I'll let Patrick tell you what Invest on Main Street is all about, but something that's right up my alley. My longtime listeners know that I'm big on, diversification, multiple streams of income. You hear me talk all the time that, while business ownership can be a great way to take more control of your livelihood, it's not passive, not in the slightest. And if you're building your business the right way, hopefully it can become more passive over time, but it's not, a true passive investment. So, I think that, anyone who's really serious about building wealth and ultimately creating true freedom for themselves, needs to be educating themselves on different types of passive investments. And that's what Patrick and his team at Invest on Main Street are all about. So with that, Patrick, really appreciate you making time to drop in here to the Path to Freedom podcast. How are you today?
Happy to be here, Wes. I'm excited about it. It's obviously a topic that has been a guiding light for me, is trying to get into that passive income and freedom on the other side of it.
Yeah. So give the listeners kind of the quick overview of Invest on Main Street. What does your firm specialize in? Who do you work with? And how do you help your clients create passive income?
Sure. So Invest on Main Street is a private equity firm. It just means that we help investors provide investments that can help accelerate their retirement and grow their retirement, so that while they're retiring, to live basically the life of their dreams and leave a legacy, inheritance to their children. alternative investments is our focus outside of the stock market. And unfortunately, most of the individuals in corporate America are only educated about 401ks and IRAs,
Yep.
and we focus to provide those real assets that provide for inflation hedging, protection from interest rates, cash flow, and net worth growth. So we do mostly multifamily apartment buildings, the large apartment communities, and also diversified energy portfolios. Both essential needs provide for amazing tax advantages and opportunity to build wealth.
Yeah, it's really interesting, and I look forward to kind of unpacking both of those investment categories with you a little bit more. But it's so true when you say that the vast majority of people out there, when it comes to investing, it's really the stock market, and even with that, it's primarily through investing into retirement funds where you really have little control over what happens to the money once you've invested it. And there's so many things that those investments are tied to. Like we're recording this in February 2023, right? There's inflation. We're hearing, depending on who you're listening to, we're in a recession. We're coming up on a recession. Like, I'm sure there's a lot of people out there really, really concerned about the value of their 401ks and IRAs, and there's really nothing they can do at this point. So, how did you get to the point where, you have your own private equity firm and you're specializing in these types of alternative investments? Because I know from chatting with you a little bit before recording, you have an interesting background and, maybe not the type of background that a lot of private equity guys out there have.
Yeah, well, I started out, not wealthy, that's for sure. I worked my way into college, and through college, got a mechanical engineering degree, did machine design, automation, and robotics, and I did well at it. I enjoy it. Even to this day, I miss it to some degree.
Mm-hmm.
The owner of the company that I was working with early on said, "Hey, you know what? I make my money in high tech, but I don't invest it there. I invest it all in real estate. I've never," I says, "put as much as you can as soon as you can in real estate." And so I did. But I was young and ambitious, and I dumped it all into some more higher risky investments, did some pre-development, personally guaranteed, and then rode that down through 9, 10, 11. So I
Yeah.
burned pretty hard.
Yeah.
Circled back into my career, got a master's in engineering and business administration, went into more high-tech robotics and medical device and aerospace and EV vehicles, did some really cool stuff, started making some money again, and I started dumping it into less risky, recession resilient markets, assets, single family homes that are existing but just run down and needed fixing up, so I could get in there, fix it up, pull out my capital and do it again and hold. And so I did that moonlighting for a lot of years. I have some articles in Forbes about the struggles of single family versus large syndicated multifamily, because it was, and the asset protection challenges along the way, trying to hang on to your wealth. So I made it into the single family. Then I finally traded up to larger apartment buildings and then diversified into energy. And it wasn't until I made those leaps that I was able to not only get income freedom, but I was able to get time freedom. I was trading up to bigger assets and syndicating and working with other passive investors along the way.
So can you kind of walk us through, because you talked a little bit about, some of the early real estate investing you did. It was riskier. You had these personal guarantees. Sounds like timing was just not great either. If that was, kind of pre 2008, 2009 that you were starting to make some of these investments. But what was it about those investments that were riskier than some of the investments that you started getting into, call it your second time around after you'd learned some tough lessons?
Well, so I learned to buy cash flowing assets, first of all, and not speculate, try to double, triple my money every year to, like you can do in a pre-development type setting. I learned to buy assets that cash flow, that have nearby comparables that are currently producing. Even in the energy space, we're not doing highly speculative drill in the middle of nowhere, wildcat, and hope we're drilling in known proven places with proven reserves nearby, adjacent producing wells. And, we're essentially farming areas like that. And so both real estate and diversified energy funds, I focus on that cash flow play, measurable improvement, value add kind of strategy, which was a combination of both doing that uh, uh, for cash flow, but also making sure I'm doing it in the right locations, which have resilience. And so just like in some markets like Vegas and Florida, Tucson, Phoenix, they had outsized proportion of their employment in their industries in recession affected businesses and verticals. So other places like Houston and Dallas had a diverse amount of employment, but those employers who are really paying your rents, those are ones that are somewhat insulated. Education, energy, finance, the military, healthcare, these all tend to have some insulation from that ebbs and flows. And so when you invest in those kinds of areas, like in Houston, for example, the market went up and 8, 9, and 10, it actually leveled off and started going up again. Whereas some other markets like the Vegases and the Tucsons and the Californias, they took anywhere from 6 to 12 years to just break even again. So
Yeah.
if you're doing it in the right spot, then and you've got the right kind of asset classes that are resilient and cash flow, you can ride out a downturn and be the tortoise, not the hare, but it takes a lot. It's a lot harder to come back from nothing again. So
That I believe. That I
Mhm.
believe. So let's talk about different asset classes, with the real estate. So it sounds like you kind of started back with single family. Now you're doing a lot of multifamily. So, why is it that you gravitate towards the multifamily, and also, if you could kind of share a little bit of what that evolution looked like for you, because I think a lot of people out there that have done any research on real estate investing realize there's a lot of benefits to multifamily, but I think it's also intimidating for a lot of people because they're envisioning, hey, I've got to have the funds to go out and buy a small apartment complex, or even a triplex or something like that. So how did you kind of start leveling up from doing some of the single family home investing, which I think is where a lot of people start,
Mhm.
when they first get into real estate investing, and graduate into some of the larger multifamily investments?
Well, I think the conversation is similar from a real estate and an energy,
Okay.
diversified energy. It's a lot of people are really good at something. Maybe they're really good at high tech like I was. Maybe they're really good at law, being a doctor, or an entrepreneur and creating franchises. And when you're really good at something, you're really badass at something, you tend to get really over indexed in that one thing,
Yeah.
right?
Yeah.
But you spent a career getting really good at it. And you think to yourself, like I did, oh, you know what? I'm so good at high tech. I can also be an expert at real estate. Forget all these people that have decades of experience and relationships and stuff to support them being successful. I can do it myself.
Mm-hmm.
What I did was I traded all my time away from my family, friends, and hobbies for that,
Mm.
right?
Yeah.
And I chose an asset class, which was single family, that I could control because I'm used to controlling and being the top dog and doing, but the reality is not only was I subtracting time away from my family, friends, and hobbies for this, I was also subtracting time away from the cash flow cow that gave me the opportunity to invest to begin with
Great point.
into assets, which not only I didn't have the ability to get the best deals because I hadn't been in the space for decades, or know how to analyze the deals or manage the deals or renovate the deals, and then even the same kind of debt products that. But also, I was putting my own name on those deals, putting my own name on the title of the properties, which allows people to find my assets, putting my name on the debt for those properties, which puts all my cross collateralizes all of my net worth into
Mm.
these.
Yeah.
And as you scaled it, it got worse and worse and worse and more risky. And then I realized trading up to larger multifamily apartments, 80 units plus, not only and partnering with other people that know how to find the better deals, uh, and have been in the space longer, allowed me to free up my time from having to do all these different things I'm not good at to maybe one or two things that I'm passionate about. Give my time with my family, friends, and hobbies back. I was able to focus on my cash flow job, but to direct it towards better markets that are not nearby me, landlord friendly growth markets that are legislative friendly, and
Mm-hmm.
to people that bring in other people that bang on doors in those markets that know how to carry properties forward, and to be able to hire on-site property management. So I'm not getting the tenant toilet and trash calls, in the middle of the night. Scaling actually brought the freedom. Scaling brought the expertise. Scaling brought the entity that I can put the property in to protect me from liability. It brought the debt product that's collateralized by the property itself
Mm-hmm.
instead of me personally, so that I now, in every one of my investments, all my passive investors, each time they invest, that's its own island. It's protected from them, you're protected from it, and all their investments are protected from each other. And so when you scale into more sophisticated and you partner up, which I should have done much earlier, that's when things really started to get out of control for me in a good way. They started to get into control, I mean, in a good way.
Sure.
And yeah, and the same thing on the energy side. People trying to get out there and do it themselves. Meanwhile, you can place investments with people with decades of experience, third generation guys that know what they're doing. And it's a rinse and repeat model for them. And you can get better tax advantages, better cash flow, and a sure bet on the upside while going enjoying your job, making cash flow, enjoying your family, and enjoying your retirement.
Isn't it funny how that works? Because it's sometimes almost, feels, for me, I've struggled with this at least. It almost feels like you're being lazy, right? By really going about it the smarter way and working with experts and people that have far more,
Mhm.
experience in something than you do. And, I think sometimes people lose sight of that, right? The whole reason, most people would tell you they want to, have multiple income streams and, make passive investments so they have more control of their time to do the things that they love. We see this when you talk about, scaling and that ultimately leading to simplicity and more freedom of time. You see this with people building businesses all the time.
Mhm.
So many business owners, they structure the business so that every single decision that has to be made, every aspect of the business revolves around them. And they really end up becoming a slave to their business where, if they can scale, and bring in people that they can delegate to and build out teams and set up really good systems and processes, that's where the freedom, can really come from. And you typically get better financial results as well because the business can grow bigger, it can
Mhm.
generate more income. So it sounds like you learned some of these same lessons on the investing side with real estate and then eventually into some of the energy investments. So it sounds like for you, making that leap from single family to multifamily was doing it through partnerships or syndications where you're investing with people that had a lot more experience, better connections, et cetera. And that's how you were able to really go about that.
Yeah, a couple of things. I really love what you're saying because it's so true. I mean, I have my book out, which I'd be happy to offer your audience as a free gift. It's Persistence, Pivots, and Game Changers. It talks about how I struggled through high tech, struggled to control it, struggled to lost it, and then got it back, and then learned how to do it right, and then started running these syndications. It gave me not only what you were saying, that time freedom, um, and the financial freedom, but what it also gave us is location freedom.
Hmm.
And
Yeah.
that's something that you should not be looked at lightly. I'll tell you why, because my wife, she does feature length animated films, she produces for like Disney, DreamWorks, and
Oh,
Nickelodeon.
wow.
And
Very cool.
yeah, and during COVID, everybody for the first time ever got sent home. And then all of a sudden, here we are working in our house together in this cute little place. We were happy there, but then everything shut down. And
Yeah.
she came out one day and goes, "So I was talking to, my coworkers, and they were saying we should move to Hawaii." And then I realized the life that I had structured allowed me to just pick up and move. And she all of a sudden became remote. 2.5 weeks later, I had us on a plane to Hawaii.
Isn't that a beautiful
And
thing?
I think we were managing like 200 million in real estate at that time. And now we're over 500, 600 million and 200. We're partnered on 200 million in natural gas and oil. investments. But the reality is that by partnering and structuring your business differently allows for that ability. And of course, I was red-eyeing back and forth on the lay flat seas, Hawaiian Air to like Houston and to Florida, but I was
Sure.
landing back in Hawaii.
That's
It was
right.
pretty magical. And it wasn't until we had our baby boy that we decided to move back closer to family. So.
Yeah, I mean, to have that freedom and flexibility to, even if it's not a permanent move, right? But be able to say, hey, we want to change up the scenery and go, live in Hawaii for 3 months, or, we want to go,
2 years.
rent an RV and travel the United States. And if you have your investments, businesses, if you own businesses, if you have that structured right, you should have the freedom and flexibility to do that. And in some cases, you can really work that to your advantage as well, where, you could relocate to somewhere where, there's no state income tax, or you're still faring much better from, a taxation standpoint. There's a lot of kind of strategic moves that could also come with more of that freedom, to operate from wherever you want to be. So yeah, that's a really, really interesting point, and super cool that you guys were able to go spend a couple of years in Hawaii.
Yeah, it was great. And I think your other comment, I kind of disrupted for a fun little story there, but it is true that we built out systems to be able to scale in real estate. But again, I'm that guy that did real estate once and saw that all the assets in real estate had challenges.
Mm-hmm.
We're in multifamily workforce housing. It's the lowest risk one, I'd say, of the bunch. 20 to 50-year-old workforce housing in recession resilient markets with really low debt. So we're cash flowing, can ride out, a market with reserves. These are pretty much built like a tank. And every single deck I said can, designed around, analyzed and underwritten around surviving another downturn like 2008. But it's one asset class. And I just got done speaking in front of 700 people in Houston this last weekend, multifamily investor network, saying, look, that's still one correlated asset. In times like today, in all of real estate, regardless of how many different types you're in, it makes sense to not only be in an alternative asset like real estate, but also something else that doesn't rise and fall with the stock market, that doesn't rise and falls with real estate, like diversified energy. It's not an essential need. It's an essential need. Housing, food, and energy.
Mm-hmm.
It provides for your franchisees, for example, the investments in energy actually come off adjusted gross income. They come off ordinary income. Unlike in real estate,
right?
Most of our investors, $100,000, they get 30 of it back with taxes.
Right.
So they're like all in at 70, and they got over 10% cash flow, 3 equity multiples we project on these things, and we're diversified across many different states, natural gas and oil, and but that kind of we don't even have plans to have debt in this fund, which means it's just simply not correlated to the same things that are driving down real estate right now. And with real estate in a correction and the stock market in a crash, this is the time to be thinking, wait a minute, I should have always been diversified, but let me do it now, because energy is an opportunity to invest in a market that's appreciating today. And so I'd like to point that out, because that's not the end all. That's one of a diversified portfolio. My passive investor guide actually shows that 25 to 50% of the high income earners and the ultra wealthy are in alternative investments. And
that's
real estate's a sliver of that.
Yeah. Well, it's such a good point, right? There's far more, to these alternative investments than just real estate. You mentioned your book earlier. You mentioned your passive investor guide. We'll make sure to put links in the show notes to make it easy for the listeners to find those, as well as any other resources that you'd like to make available to them. But highly recommend folks checking out both the book and the passive investor guide. I was actually taking a look at that last night, I believe, kind of just preparing for this. If you're listening to this podcast, then there's a good chance that you're looking to create more freedom in your own life. There's also a good chance that you realize that owning your own business can be a great way to take more control of your livelihood and create more of that freedom that we're all looking for. Also, if you've been listening to the show for a while, you realize that I specialize in franchise ownership. In addition to owning franchise businesses myself, I have a franchise consulting firm, Path to Freedom, where I help people navigate what is typically an overwhelming process of understanding franchising, identifying specific franchise companies that could be a fit, and then conducting the due diligence in a thorough and efficient manner with those franchise brands. My whole purpose here is to leverage my experience working for franchisors, owning franchises myself, and how we've been able to use that to create more freedom in our lives and help you determine if that could be a path that makes sense for you as well. So if any of this sounds interesting, if you've considered business ownership in the past, whether you've explored franchising specifically or not, I'd love to connect with you. I'd love to learn more about you and what it is that you're working towards in your life and determine if I may be in a position to help. A great starting point is the link below in the show notes, which will take you to a short form to fill out, and you'll receive a free copy of an ebook that I've put together, The 7 Steps to Freedom Through Franchise Ownership. That'll also get us connected, and I'd love to set up an introductory call where I can explain a little bit more about the process that I use to help people determine if franchise ownership could be a great way to start charting their own path to freedom. So click the link below in the show notes, receive the ebook, and let's get connected. I'd love to hear from you. So talk a little bit more about the diversified energy investments, because I think most people, have at least a general sense of, multi-family and real estate investing and kind of what that entails. But I know when I first got introduced to the concept of diversified energy as an alternative investment, I didn't have a clue. I'm still far from an expert, but I have a little better understanding of what that entails. But for those that may not be familiar with it, what exactly do you mean when you talk about diversified energy investments?
Yeah, well, so diversified energy is that actually the way we describe our fund, because it's not proliferate. In fact, there aren't any others out that I'm aware of that are even close to doing what we're doing. And it's not that we're doing something new, it's like we're just doing lots of something that's old. And traditionally, natural gas and oil drilling does have a bad rap. It has a bad rap because people would be drilling out in the middle of nowhere, trying to get 100x returns, and ultimately they would lose all their investors' capital. But we don't do that. We're drilling like in real estate. We're going to build somewhere where there's nearby buildings that have value and are producing income. We're going to build on a pad that's known, proven market, right? In real estate and oil and gas, we're purchasing leases where there are adjacent analogous wells producing. We have 3D seismic to tell us how far down to go to find it. And we don't just do one vertical well, we do a vertical well that then goes horizontal. We'll go 1 or 2 miles in that zone. So since we're doing it that way, it's much higher likelihood of being successful. Now, that is how we buy proven secured assets, right? And we drill, but we also do it at scale, and which is very unique because pretty much every other operator that I know of that provides an oil and gas investment puts you in 1 well, maybe 2 well, 3 max maybe, and then that's it. You only have a piece of the cash flow of that well. You actually don't have any ownership over the lease. Right. You don't have any ownership over this. Well, we're going to do it at scale. We're going to get leases in lots of different places, all on proven reserves. We're going to put all those leases in the fund, so you actually have the secured asset. Normal oil and gas operators are kind of like saying, analogous to a multifamily apartment. It's like, this 1 unit, we're going to give you the cash flow of just this 1 unit. Now, we own the building. It's like we own the lease. You only get cash flow from, and by the way, if the tenants stop paying, you lose it all. If it burns or floods or there's a blowout, you lose it all.
Yeah.
But if they succeed and there's cash flow, the building appreciates, right? But then the operators in the oil and gas hold that. So what we're saying is, as we drill in these leases, it's going to provide more cash flow to you. You're going to have diversification over lots of wells. And as the lease appreciates because of the proven reserves and the producing wells, as well as the additional wells we find that we can drill, all that gives value and that gives you an exit. So you're not stuck in one well forever, chance of losing it all. You're in a situation where you're cash flowing and appreciating your net worth at the same time. We're going to do that in lots of different places at scale, which provides geographic diversification, political diversification into the drill-friendly locations, analogous to landlord-friendly, right? And we're going to do geologies, which allow us to drill for different hydrocarbons, which is a totally unique thing right there, too. In fact, we're going to target oil at 50% and natural gas at 50%, which are two different commodities and actually are both very much so in demand, but not always the case. So it's good to be able to pivot between one and the other, right? And so with that scale, the secured asset, the diversification play allows you to, like in a multifamily deal, if a unit burns, has a flood, or a tenant stops paying, it doesn't tank the deal because you have economies of scale, right? In our deal, sure, we had a dry hole. Sure, we had a drill bit stuck halfway down or a well that was not operationally efficient to drill. We pulled out. But nobody lost their money in that because we were doing 130 wells in our last fund and it washed out in the economies of scale. Again, not getting rich quick like Beverly Hillbillies, Jed Clampett, because we're paying the piper the reserves, but we're drilling in known spot. We're getting reasonable cash flow and appreciation, and then a 1031 exchange forward to preserve legacy wealth. So that's really the gist of the diversified energy fund. That was a lot.
Yeah,
right?
but it makes sense. You walking it through it, I guess, kind of how, your firm is doing it differently and packaging it differently for your investors. So, this approach that you're using where you are so diversified across, all these different drilling sites, does that mean that, ultimately, you have to raise far more capital than maybe some of the other groups out there that are, not going to be as diversified, where it's maybe just, like you said, 1, 2, 3 max different wells or drilling sites?
Yeah, oftentimes the other investments are, well, we have one pad in one location. We already have other wells in that location. We're going to drill one more, so it's very low risk. Well, they're also kind of still in the reserves from the adjacent wells that they sold to other people. But oftentimes, and because you don't own the lease, you don't get any of that. But oftentimes, what they're saying is they're going to drill down to a certain depth, just one vertical well, right? And then just raise $1 million, right? Or $2 million or $3 million to do that. But you may not get anything and you may lose it all, right? If you do a full horizontal well, it may be like $10 million, but you're going 1 to 2 miles along a proven reserve area, much higher likelihood of having much more efficient and stable long-term production, right? So, but to do this safely, you not only need to do vertical wells, you need to do vertical wells in multiple different leased locations and in different geologies. So we probably need to do 20 vertical wells or more, right? And so, yeah, we're raising with my partners, we're raising $200 million, right? But we're working with operators that have been doing this for 26 years. We're working with people that are 4th generation oil guys. We're working with people that already have concentration in 5 different basins or markets, right? And have a success in those areas. So yeah, it takes scale to do things in a safer way than the one-off type investments. Long answer, but that's
no, great answer. So one of your investors wants to put money into this. They're getting access to everything across the board that you're doing from an oil and natural gas standpoint. Am I understanding that correctly?
Yeah, it's stand up a fund, raise the capital, execute on that 3 to 5 year time frame, 1031 exchange forward. Once you invest, you're in all the assets, the leases, the wells, the production, the exit. You have everything within that fund.
Very cool. So let's zoom out a little bit. You've mentioned, your investors, your clientele. I mean, who is, I guess, kind of your ideal client, right? Who are the types of people that are investing money with your firm?
Well, so I started out raising capital from a lot of my high tech business owners, entrepreneurs, people that I used to do one of a kind machine automation and robotics stuff with. But now it's lawyers and doctors, people, CXOs, high incomers that desperately need ordinary W-2 income tax write-offs that real estate doesn't provide. And essentially people that are really good at doing their thing and they
Hmm.
make a lot of income. They want to diversify. They want to be passive. They want to trade up to larger assets at scale that'll get them somewhere, but they don't want it to take over their life. And so those are usually accredited investors. That means 200,000 in income as an individual, 300,000 when combined with your spouse, and or a million in net worth. One of those
Right.
three, but not including your personal residence. And our minimums are 100,000. And I've always done it that way since the beginning. And that work tracks the right kind of investors. And because we work with accredited investors, allows me to talk to you right now about it. And if I wasn't working with accredited investors, I couldn't talk about my deals
Yeah.
openly like this.
Yeah.
So it's Mhm.
Yeah. And so with the accredited investors, I think you said it, it's 200,000 in annual income or 300,000 for the household if you're married. Doesn't that
Mhm.
have to be for a certain number of years in a row too, based on your tax returns, or no?
Yeah. So on the income basis, it's for the prior 2 years with a reasonable expectation it'll
Prior to
continue.
2 years. Yeah.
Mhm.
Or $1 million net worth,
Joint.
not
Mhm.
including primary residence though. So
Right.
this is not for everyone, right? There's people that are probably just not yet at a point in their, career and their wealth building where, a fund like any of yours would be an option for them. So, I guess one question I'd love to have you speak to, because a lot of my listeners are, they fall into one of two buckets. They're either aspiring business owners, right? So they may, be at some point in a corporate career, but they like the idea of owning their own business and ultimately having more control of their livelihood. I have a lot of, existing small business owners that, are looking to grow their businesses, but, just like we're talking about today, they're looking for ways to put, the money that their businesses are generating for them to work in a smart, more passive way. So what advice would you have for, folks listening that, may not yet be at a point where they would qualify to be an accredited investor? You mentioned $100,000 minimum, which from what I've seen is pretty standard for these types of investments.
Mhm.
I think I've seen some that are, maybe 50,000, but I doubt you find anything less than that. So where would you recommend starting, if you are looking for more passive investments, if you're not yet quite at a point where you're an accredited investor, you have $100,000 that you can invest at one time?
Yeah, well, I get a lot of calls. First of all, I'm happy to take those calls. I get a lot of individuals with those in that situation, and they frankly will never hear from somebody like me who takes non-accredited investors because they're not allowed to openly solicit. So it takes somebody like me to get out there and talk about it so you even know these types of investments exist.
Hmm.
And I can point you to some other people who file under more friends and family types, so you can call them, build a relationship, and in a subsequent investment, you could potentially invest. But a lot of the times when people get on the phone with me, they don't realize they're accredited because you can add up. I mean, while your capital's in your single family home, it is. But a lot of individuals are saying, "Oh man, I could retire next year if I could invest in these passive income vehicles." Well, you can refinance the house, right? And as soon as the capital's out, you're all of a sudden accredited overnight.
Yeah.
In
Yeah.
fact, home equity is one of the most risky places because it's in your own name and you can get sued and the market could crash. And so there's some financial wealth strategies there. A lot of people don't realize that their IRA and 401ks are not trapped forever in your financial planner's clause, right? You can
Yeah.
actually take a piece of those, and I have an article in Forbes on this. Patrick Grimes Forbes and then IRA and 401k. You can take a piece of
Okay.
those like I did for my high tech days, transfer it over to a self-directed variant, and all of a sudden, where America most has most of their wealth, in their home and in their retirement account, you can take a healthy piece of that self-directed and then start putting it into non-correlated investments or investments that are hedged against inflation and interest rate, cash flow, and appreciate even in down markets.
Interesting.
And so that's another option for it. The other option is a lot of people that have rental properties, as you were saying, if you look at the equity that they have, they tend to really, like I did, focus on, oh, I bought this really good deal and now it's appreciated to here. But if you look at that equity and you look, what's your cash flow on the equity? What's your cash flow on that equity? Then it's usually really low. They're like, well, I'm getting a quote, good return, which just means they bought it at this price and now they're cash flowing this month. But they're actually not putting that equity to work. In order to put that equity to work, you have to put it into something that needs fixing up. Well, if you've already fixed that thing up, then your return's going down because the longer you keep it, the lower that IRR is. And the reality is to keep the return on your equity high, it's a job. You have to keep finding new things to sell it, buy a new one, fix it up, sell it, buy a new one, fix it up. And that's when people just let it ride, which your IRR goes down. Now, rental properties, you can sell and use a 1031 exchange and partner with me. If you can trade $500,000 in equity or more into a larger apartment deal, into an emerging market that we bought at a discount, off market, that's under market rents that we can renovate and improve, build an extra building, add value, and then return your capital to you and continue to passively cash flow, and you're not doing anything. You can actually trade out of a landlord tenant, toilet, and trash using a 1031 exchange into a more passive position into a large apartment deal. Later on this year, go ahead.
I was just saying that I did not know. That's interesting.
So Patrick Grimes, Forbes 1031.
Okay.
Or you can go to investonmainstreet.com/1031. We have a whole guide on how we structure these called tenant in commons, which allows you to sell real property in your own name and buy a percent interest in your own name of our larger assets, right? So then you're in now that return on equity, we're always going to have that maximized because we got a whole team of people finding those deals that you will never find. Acquisitions guys taking those deals down, asset managers that are constantly renovating, refining out your capital out of the 1031, and then new deals to 1031 forward. And you can certainly choose to take it away at one time, but most people just stick with us, we'll keep that return on equity high.
Right? So my wife and I have a small commercial property that we own. We bought it 3 or 4 years ago, and rented it to 2 of our businesses that we own. And since then, our businesses have outgrown this property, and we had to move to something larger, which we now lease. And we're under contract to sell this commercial property, and have been thinking of doing a 1031 exchange, but our thought was, we'll just go into something else that essentially, we'll own and manage. But you're saying we could 1031 exchange the proceeds from selling this property and redirect it into a fund like yours.
A partnership interest in a large multifamily apartment building. Yeah. Mm-hmm.
Interesting.
Now, later on this year, one of the things that I talked about before is on the diversified energy front. We work to provide options, Congress willing, to 1031 exchange forward. Now, that means we have a 1031 exchange vehicle in energy. And what is oil and gas? And what is a little known exception to the IRS like-kind exchange, which is what they require for 1031 exchanges, is that you can actually exchange real property into oil and gas interests to stimulate the production of natural gas and oil domestically. Again, if you invest where the IRS wants you to house, feed, and energize America, you're going to reap amazing benefits. So in this fund that we're working to launch Q2, 3, you could actually sell rental property, commercial property, whatever it is, and 1031 exchange into a diversified oil and gas deal.
But that's not currently an option
Right.
We're
Mhm.
hoping that Congress passes a law that makes that an option.
Oh, no, it's an option.
It's an
It's an
option.
option.
Okay,
Yeah.
I got you.
I just meant every 4 years, the people we hear murmurings about taking away the 1031
I
exchange.
got you. Yeah, yeah.
It's
Okay.
never happened. It's the wealthiest people that have, it's never going to happen. And as soon as they do, there's already other vehicles that can be used, deferred sales trust and stuff like that. So we're never going to stop doing this. But I just said Congress willing, meaning like if somebody tries to take away the 1031
I
exchange,
got you. Yeah, yeah. Okay.
but anyways, so the 1031 exchange is currently the case. We can currently trade into real estate. Later on this year, we're going to have an option to trade into oil and gas deals and take your wealth from real property and change it into oil and gas interests to balance out your portfolio. Keep in mind, if you're doing a 1031 exchange from single family, from anything, into one of our deals, you do not have to be an accredited investor.
Mm.
So you only have to be an accredited investor if you're investing not through a like kind exchange through property. If you're doing that and you're just playing up with cash, show up the table with cash, then you need to be an accredited investor.
Okay. Also good to know. So that could be a way that someone who's not yet an accredited investor, maybe doesn't have the cash on hand to make the minimum investment, but if they own, one or two investment properties, they could get out of that and roll into a fund like yours.
Yes.
Very cool. Very cool. Well, this has been great. What else would you like the audience to know, whether it's about, your firm and what you guys do to help your investors, how you do it differently? You've got a ton of resources on your website, several of which have been mentioned already, including the book Persistence, Pivots, and Game Changers. So like I said, we'll link all of that in the show notes, make it really easy for people to find. But are there any other specific resources you'd like to point people to, or anything else you want to make sure the listeners hear?
Yeah, I just recommend if you think you might be an accredited investor, let's have that conversation. I struggled when I first started as a robotics guy in a consulting business, and it wasn't until I realized I could value the business and add that to my net worth that I was all of a sudden accredited overnight. And so people don't realize. And then, well, what about your car? What about once you talk to somebody, oftentimes they end up being credited, they don't realize it, right?
Right.
So I'd say that the opportunities here, just start the conversation and see where it leads, right? And a lot of people listen to podcasts and they just, I should do that. I should just investonmainstreet.com/contact. Worst case, you end up with a free hard copy of my Amazon #1 best-selling book, signed and sent to you. And we provide those as a welcome gift to people that engage with us, and I'm happy to help it contributes to, especially the entrepreneurship of your listeners, or the type of people that I really like talking to. So
yeah, absolutely,
entertain those conversations.
Absolutely. Well, again, we'll put all the links. So where can people go to get a free copy of the book if they'd like?
Yeah, so invest on Main and then Street, all spelled out, investonmainstreet.com/book.
Got it.
And to set up a meeting, it's investonmainstreet.com/contact. And you'll see my calendar. You just book a time right on it.
Yeah. Well, I think your advice is spot on, right? I mean, even if you aren't yet accredited, like, it's never too early to start learning these things, understand, because I'm sure you see it all the time, right? Where someone thinks they're not accredited, but they actually are qualified to become an accredited investor, or they're a lot closer to being able to qualify than maybe they thought. So it's never too early to start educating yourself on, the many different types of investment vehicles that are out there, and establishing these types of relationships. So that's great advice, Patrick. If this is interesting to anyone, reach out, have a conversation with Patrick and his team. Same thing I encourage people to do with me. If they just have a little bit of interest in franchise ownership, and it's something they want to get a little better understanding of, right? It doesn't mean that, you're going to end up buying a franchise in the next 12 months, but, you got to start learning somewhere, right? So action always trumps fear, right? Just start
100%.
taking steps in the right direction. Well, Patrick, this has been a lot of fun, man. I really enjoyed hearing from you. I learned a lot myself just from this short conversation today. And like I said, we got this property under contract, so maybe we need to talk further offline about 1031, because I mean, in our area right now, there's not any good real estate deals out there to be had, especially for someone like me that's not my area of expertise, and I don't particularly know what I'm looking for in the first place. But I think it's even harder times than many to find a good deal. So we'll have to talk more offline about that. But go check out Patrick's website, Invest on Main Street, get a free copy of the book, and reach out to Patrick to have a free conversation today. Learn whether or not maybe you're an accredited investor, and check out more of the investment opportunities that he has. But Patrick, thanks so much for dropping in. I really appreciate it.
Great time, Wes.